Let's take a look at the bigger picture. Eddie Ghabour, owner of Key Advisors, joining me now. So what do you think here? I mean, is there a real rally happening here, or is this some sort of bear market rally? What's going on?
I think it's a bear market rally. I mean, this is very typical in bear markets, like 08, 09, the tech bubble burst. And look, you can see some non-quality companies that are on the potential brink of bankruptcy rallying, So when you see that, it just kind of goes to show the type of market that we're in. And look, I need to see the economic data strengthen or at least flatten out before we turn bullish. But I think that one thing to us that is clear is that the consumer is their strength is deteriorating. We have the cost of capital for corporations that are extremely high relative to where they were a year ago. And I think as we get more and more earnings numbers in the coming weeks and hear from big tech, that it's going to be clear that we are still in a bear market. We're not out of the woods. And I think we're going to hit new lows before we hit new highs. So we're going to continue to be patient here and see how the chips fall.
Were you surprised to hear so many of the bank CEOs talking about a mild recession on its way? That seemed to be the most likely case.
I think they're always going to use the word mild to hedge it, right? They're not going to be like me and come out and be so blunt and say that I don't think a soft landing is possible considering how fast rates have increased. But look, they're not want to disrupt the apple cart. So I just don't see how a soft landing is in the equation if the Fed is not going to cut rates. I don't see them cutting rates. And again, the argument of the Fed cutting rates, to me, supports the fact that the economy would get worse, because if you think the Fed's going to cut rates, they're only going to cut rates if things get really bad economically. Otherwise, what's the purpose of cutting rates? So you got the Fed working against us. We got earnings. And look, this is just a normal cycle that we see every 7 to 10 years where you're going into a recession, and everything from the bond market to the consumer to earnings to real estate is pointing that things are going to get weaker, not stronger. So I don't see that as a bullish sign.
Right, understood. I mean, at this point now, we'll be waiting on the PPI report. Do you think that will be telling? We've got in the manufacturing, New York manufacturing, and that showed contraction. I mean, we've seen some of the prints just basically slower growth, inflation coming down. Is the Fed doing too much? And what do you expect from the PPI?
So I think you're going to see over the next several months, CPI is going to trend downwards because we are, in our opinion, heading into a recession. And that's what happens when demand starts to go away. You're going to see prices come down. So there are time periods where CPI going down is not a bullish catalyst. And do I think the Fed did too much or is doing too much? I think they already have, because we haven't even seen the impacts of the rate hikes they've done yet, because it takes months for it to circulate into the system. And I think it's really more of a matter of how fast they've done it. This is an experiment that we've never seen before. And I'm not willing to sit back and bet on them being able to navigate this and assume that they're going to be able to do a soft landing. I'd rather sit on the sidelines with a big percentage of client assets and wait and see if they're actually able to navigate it. I think the probability of them navigating a soft landing with as fast as they've moved on tightening during an economic slowdown, I think that's a very low probability.
Right. So at this point now, I sense your tepidness and concern. What do you tell investors?
So right now, a big bulk of our assets that we manage in our tactical strategies is in cash. Look, money markets are giving us yields now that we haven't had in quite a long time. And so our security positions that we would buy on weakness would be things like healthcare, consumer staples, maybe even utilities. Treasuries are an area that we will be looking to add a little bit to as well, but keeping a big part of our core positioning in cash, because we want to be able to buy the market if we are right in the fact that we're going to get a new low before a new high. And the only way to really be able to take advantage of that and grow someone's wealth is to actually have cash to be able to buy it. So we have to be patient here. That's tough to do as an investor, but I think it's going to end up playing out to be the most prudent approach, because by summertime, I think it's going to be clear whether we're right or not.
I see at this point. So a lot of cash. Are you worried that you might be missing opportunity by sitting in cash? For example, Meta was up over 10%. Year to date, it's up 12%. The S&P had a great week last week. It was up 2.7%. The NASDAQ was up 4.5%. The Russell was up 5.2%. You're missing the moves.
You only missed a move based on when you timed your raising of cash or getting out of those areas. We started getting out of tech a year ago and over a year ago. So even though these stocks have had big moves, they still need huge returns just to get back to where they were. And again, it's very typical to see the things that have sold off the most to have the bigger rallies and bear bounces. But look, anyone that bought bear bounces last year ultimately watched the market make a new lower low. So they may have looked pretty smart in making that trade for 2, 3, 4 weeks. But after that, it made new lows. And I think all of those you can look at pre-COVID levels, and that's where I think they're going. So again, we're looking at the trend, and the trend to us is going down. So I don't worry about a 1 or 2 or 3 week move because we're looking at it from a total scope perspective. And again, the timing of when we raised cash was pretty good. So we have the luxury of being able to be patient and not having to chase.
Right, understood. At this point, when you look at the different sectors, we've heard a lot from the banks already because earnings season is underway. What sectors are you following most closely? I mean, we saw energy doing well last year. People often go into ETFs or dividend payers or things like that. Any thoughts on some groups?
Look, I want to see the companies like the retail companies, as consumer discretionary names. I want to see really how strong the consumer really is. Because the narrative that I continue to hear from a lot of folks is that the consumer's still in good shape because of how much cash they have. Well, I want to see data that actually supports that. Because if we see the consumer getting extremely weak, we are a consumer-driven economy. If we see weakening that we think we're going to see, then I think that's going to support our thesis that we're going into a recession. If we see surprises in that space, then maybe we're wrong and we'll have to pivot. The other area is real estate. Real estate's the one asset that held up real well last year. There's not another area, in my opinion, that touches more parts of the economy than real estate. If we start to see a massive slowdown there and companies start laying off employees and subcontractors and lenders, that could ultimately take us to a harder landing than what the market's priced in, because they think that because the rates are going to get lower, that maybe that'll bring mortgage demand back. And I think housing is going to be extremely challenged this year.
And when you say real estate, how at least it's sort of held up, at least in part, you don't mean buying into commercial REITs, right?
Oh, no. Look, I think the commercial space has a lot of challenges this year. Again, what's going to happen when they have to refinance their debt at higher rates? I'm talking about just real estate numbers in regards to single-family homes, seeing the rate of change on sales there. We're already seeing luxury home sales come down pretty big on a percentage basis. So that's telling us that the high-end market is starting to really slow down because they probably are seeing what we see and just want to kind of sit back before they make any major purchase. But, you know, if you get home sales declining at a rapid rate, they're going to have to lay off a lot of employees, and that touches a big part of our economy.
Yeah, well, that's the whole thing. And you said you do think it gets better before it gets worse. So how far lower does the market go? Are we retesting lows? Do we make new lows?
We're going to make new lows, in our opinion. Look, I think a S&P at a 3,200 range is not too far-fetched. And if it hits 3,200, then you could have another leg down based on technicals. So where we would be wrong is if we're not in a recession this year. If we do not go into a recession, then we're going to be wrong in our assessment of where the market is going. If we are going to have a hard landing, it is our opinion that we will be right in regards to our market assessment. And again, I think in the next several months, the data that's going to come out from earnings and corporations are going to really be very telling, again, on who's right, whether this is a new bull market or this is nothing more than a bear bounce.